Hey there! So today, we're going to pull back the curtain on a really important metric for investors. It's called book value per share, or BVPS for short. And it's all about looking past that flashy stock price to see what a company might really be worth.
You know, every single one of us who invests has faced this question. You see a stock, you see its price, but how in the world do you know if it's a genuine bargain or if you're just paying what everyone else is paying? It all comes down to figuring out a company's true value.
So that leads to the big question. Is that number you see flashing on the screen the final word on what a company's worth? Well, let me just say, not even close. The market price tells you what people are willing to pay right now. But there's a totally different way to look at value, a more grounded, on-the-books kind of way.
And that's where our main topic comes in, book value. Think of it like this. We're peeling back all the layers of market hype, all the speculation about the future, just to see what the company's worth according to its own financial records.
So, what is BVPS, really? It answers a simple but really powerful question. If a company just decided to close up shop today, sell off everything it owns, and then use that cash to pay back every single penny it owes, what would be left over for the shareholders on a per-share basis? It's basically the company's net worth, on paper.
Okay, let's make this real. Let's imagine a company called Pies R Us. They've got buildings, delivery trucks, giant ovens, you name it. Now, if they sold all that stuff and used the money to pay off all their loans and bills, whatever cash is left in the pile is their book value. And if you divide that pile of cash by the total number of shares, you've got your book value per share. Simple as that. So how do we actually get this number? Well, it's not some kind of dark art. It comes straight from the company's accounting books. Let's break down the actual formula.
Now, don't let the formula scare you. It's actually really straightforward. You take the total shareholder equity from the balance sheet, you subtract out any preferred equity, and then you just divide that number by the total number of common shares out there. See? It's all based on historical data. No guesswork involved.
All right, let's plug in the numbers for our Pies R Us company. Let's say it's common equity. So the value that belongs just to the common shareholders is $10 million. That's our starting point, the top part of our little equation. Okay, now for the bottom part. The company has 1 million shares of common stock in the hands of investors. This is the number of slices we're going to divide our $10 million equity pie into. And a little quick math, $10 million divided by 1 million shares gives us exactly $10. So the book value per share is $10. On paper, each share of this company represents $10 of its net assets. But wait a minute. Here's where it gets really interesting. If the book value is $10, why might the stock be trading at, say, $5 or maybe $50? This gets us to the absolute core of it all, the huge difference between book value and market value. The key thing to get here is that these are two completely different ways of looking at things. Book value, that's the accountant's view. It's all about historical facts, what's physically on the books. But market value, that's the investor's view. It's a bet on the future. It's about growth, potential, and future profits.
Always remember, book value is looking in the rearview mirror. It's calculated using old numbers from the balance sheet. It's a snapshot of what's already happened, not what might happen tomorrow.
And then you've got market value. This thing is alive, it's dynamic, it can be emotional, and it's always looking ahead. It gets pushed around by news, by feelings, and by what everyone thinks a company is going to earn in the future.
Now, it's super important to understand what VVPS can't do. It's a fantastic tool for sure, but it has some serious blind spots. It definitely does not see the whole picture.
Think about it. Book value is great at measuring a factory's machines or a bank's assets. But how does it measure the value of the Nike swoosh or the secret recipe for Coca-Cola? These things, the brand, the patents, the customer loyalty, they're incredibly valuable, but they're often worth little to nothing on the actual balance sheet. And that's why a big bank might trade close to its book value, while a hot tech company trades for, 10, 20, or even 50 times its book value.
This quote from our source material just nails it, doesn't it? BVPS is stuck looking at the books, and in our modern economy, so much of a company's real value isn't found on a traditional balance sheet.
So what's the takeaway? How should you actually use this thing? Well, think of BVPS as a starting point, never the final word. Famous value investors like Benjamin Graham, Warren Buffett's mentor, literally made their fortunes finding companies that were trading for less than their net assets. Today, it's a great tool for spotting potentially undervalued companies that have a lot of physical stuff, like industrial firms or banks. It can help you find places where the market might have gotten too pessimistic and push the price below its on-paper liquidation value.
And that leaves us with one final thought. The next time you look up a stock price, just ask yourself, what story are the books telling me? And what hidden, forward-looking value is the market seeing that the books just can't? Thanks for tuning in to this explainer.